Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Meta and Microsoft surging in trading today. We'll discuss the outlook for big tech with Apple and Amazon set to report after the bell. Plus, Treasury Secretary Scott Bessent meeting with Trump on the China trade deal ahead of the president's self-imposed deadline for additional trade deals. We'll bring you the latest. And the Federal Reserve leaving rates on pause as the Fed assesses the inflationary impact of tariffs. What does it mean for the economy? We'll discuss that and more on Market Catalysts. Let's first get a check of the markets here. We are seeing strength across the board today, but the most strength, as you might imagine, in the NASDAQ composite because of those earnings from Meta and Microsoft. Right now, the Dow up about 123 points. That's about 0.25%. The S&P up 0.8%, and the NASDAQ up 1.2%. But let's dive into what we are seeing in terms of those market cap shifts within the NASDAQ 100. Here is a look at market caps here. Microsoft right now at this moment just under $4 trillion, but it hit that $4 trillion market cap for the first time ever earlier in the session. We'll see how it goes as the day goes on. Of course, NVIDIA at over 4.4 billion. But if you look at the percentage gains that we are seeing today, pretty remarkable to see companies of this size gain by how much they're gaining. Now, Microsoft is not at that record high in terms of the price or the market cap anymore. It's come down a little bit from the highs of the session, but still up 4.5%. Meta, though, is just holding strong. That stock is up 12%, went up, and it is staying up. So interesting to see all the action that we are watching there that's going on. We also, of course, continue to watch what's going on in the bond market here as we get sort of the feed through from the Federal Reserve yesterday. We continue to watch the fallout across currencies and across yields today as expectations continue to fall for the Fed to cut rates in September. Here's a look at the two-day yield that we have seen on the 10-year. It's come down a little bit here. 4.35% is where we stand right now. But let's get more on big cap tech right now. Meta and Microsoft shares rocketing higher. Microsoft topping a $4 trillion market cap off the back of their strong earnings results, although it is pulled back a little bit right now. But the AI euphoria fueling a rally in broader markets as well. Joining me now on this, Yahoo Finance tech editor Dan Howley. Dan, first of all, give us some of your takeaways, some of your themes that we saw from these results.
Yeah, I mean, look, let's start off, obviously, you've mentioned it, Microsoft hitting the $4 trillion mark, just the second company to do this beyond NVIDIA. I think, you know, the highlight number for Microsoft during the call was its $75 billion in revenue from Azure. That's the first time we really got Azure revenue from Microsoft. Previously, it was like, okay, well, Azure growth was X percentage. Intelligent Cloud, which includes Azure, brought in blank number. So you had to kind of infer what Azure was a part of that. But now they're coming out and saying it was 34% growth, I believe, on that $75 billion of revenue. That's year over year for the company. Huge win for Microsoft. A lot of obviously the benefit of OpenAI being a part of Microsoft, using their cloud infrastructure. Also, Microsoft spreading that technology out across its different product offerings. And then on Meta's side of things, look, they beat on the top and bottom line just like Microsoft, and then they offered better than anticipated Q3 expectations. So that obviously sent shares higher. The company also acknowledged the kind of moves that they're doing as far as their AI recruitment, where they're poaching people from OpenAI or Apple and bringing them into their super intelligence lab. They said that there's going to continue to be upward pressure on spending. That includes the data center, but then they also basically said, look, we're hiring a lot of people for this, so that's going to be the second main contributor to that upward pressure. So it's a lot going on for both companies here, but obviously the biggest takeaway overall is that their AI efforts appear to be paying off big time at this point. And don't forget, we had just seen Google announce in last week saying more or less the same thing. Amazon's after the bell today. They really need to show that their AI efforts are stepping up, or the market could turn sour on them.
Dan, tell me if it feels this way to you. Obviously we've been talking about AI for a while. We've been talking about the big spending that we've been seeing for a while. But it felt there, especially when it came to sort of software names, but also even these names, like, was it actually real? Was it actually happening? Was it actually starting to bear fruit? And this feels like the quarter maybe that is that tipping point. Because not only are we hearing from these companies, we're hearing from a lot of the enterprise software companies, the ServiceNows of the world, for example, that are also using this stuff. So it feels like we maybe are getting to that point. What do you think from your coverage?
Yeah, Julie, I think you're totally right. I mean, we were previously talking about how they're, plowing billions of dollars into these data centers, springing up all around the country. There's been obviously the conversation of, how those impact neighbors in regions, the electrical usage, the water usage. Those continue to be issues as well. But, on the revenue side, we're starting to see that kind of pay off, those big build outs showing for them finally. Now, I think one of the things to point out is that for something like an OpenAI, they're getting a lot of that through consumers, regular folks who are just going on and using OpenAI, ChatGPT. But for the likes of Microsoft or Google, that's also going to be on the consumer side, but also in the enterprise side. Microsoft is really, enterprise forward, and so they're benefiting from the enterprises at large. I think, we've kind of had the discussion before where, in my mind, right now at least, the enterprise is where AI kind of makes sense the most. You have Apple being criticized for not having AI in their iPhone. That's up to snuff. I mean, are you going to buy an iPhone because of the software? You never have. You didn't go out and buy it for Siri to begin with. You bought it because it had a better camera. So I don't really know if that's going to be, there's going to be a moment where you say, cool, awesome software on this iPhone, got to go out and buy it now. You're going to say, cool, it folds, or cool, it's a lot thinner, I got to go out and buy it now. Or my battery stinks, I need a new one. The consumer side is still kind of everybody in their like little app silos. You're on your ChatGPT, you're on your Gemini. Right. But for the enterprise, I think that really is what the big story is, and that's really where we're starting to see this growth.
Yes, it's been a really interesting trend to watch. Somebody else who's been watching and is joining us now, that is Brent Thill, Jefferies senior analyst. Brent, it's good to see you. So we've been talking about this sort of tipping point that we've been reaching with these companies, and I know you've been talking about it for a while, even though, as you and I have talked about in the past, maybe it's unfolded a little bit more slowly than at first promised, but it feels like we're there. Is that what these results tell us?
I mean, we're at the beginning of the AI adoption cycle, and I think everyone has been questioning these Capex investments. What we've been saying is they're seeing accelerating revenue, they're seeing accelerating bookings, they're seeing margins that are higher. Amy Hood just gave you margins that are higher in the last 2 years, even in the face of AI. And they've guided to flat margins, which is still pretty incredible given all the investments that are going in. So I'd say that we're not there yet. The enterprise still has not adopted AI, and that wave is yet to come. And so if you think about today across the entire software industry, less than 5% of total revenue is AI. And when that gets to 15, 20, 30% in 2027, 2028, then we'll be there. We're clearly there on the investment thesis, which is you want to be ahead of this AI wave. There is, as I've said, only 5 companies that really monetize AI in a big way inside software, which is the companies that have the data, have the users, and have the capital. And
we look like we're having a little problem with Brent's shot, but Dan, you wanted to get in here.
Yeah, look, Brent had made a point. AI is not throughout the enterprise yet. He's right. We talk so much about the cloud. A lot of businesses aren't in the cloud still, right? There's so many businesses out there. The cloud in and of itself still has some runway to go. We were talking about, Microsoft was talking about their on-prem business, which is their on-premises business where people stand up servers in their own individual office buildings. Maybe they need to have them more secure or whatnot. So that's part of their cloud business as well. The cloud in and of itself still has runway. This is the beginning of AI. we'll obviously see if it continues to build like this. But if it's anything like the cloud, then there's going to be continue to be more and more space for it to build out.
Something else I want to point out that you and I were talking about this morning and that Laura Martin of Needham pointed out is the relative spending of these various companies, right? The Capex. And I think the point that she's making with respect to Meta in particular, on which she is neutral equivalent rated, is that if you look at something like Capex to sales, in other words, how much these companies are spending relative to their size, the size of their revenue, Meta is a lot higher than the others in terms of the amount of what it's bringing in that's going out the door for this stuff. And she's really questioning the rationale of Meta on that front. Now, the noise on that has gotten a lot quieter with regard to Meta, right? But, it's interesting that she's still bringing up that point.
Yeah, and look, I was just pulling up Meta's market cap. They're going to continue to spend, as I said, on the data centers as well as the people. They're building out this data center that's like, I don't know, they overlaid it on an outline of Manhattan, and it takes up a huge chunk of the city itself. Not going to obviously land in Manhattan. It's going to be somewhere else in the country, I think Tennessee or around there. But their market cap is $1.96 trillion right now. Microsoft seemed to indicate that they were going to be slowing a bit on their Capex, whereas Meta's saying, look, we're going all in. We're doing AI for ourselves. We're doing open source. So it seemed to indicate that they're not going to be open sourcing all of their AI models going forward. And then they have obviously the consumer business as far as hardware goes. So they continue to lay these out. But you're right, it does seem a little misbalanced when you look at, okay, Microsoft is powering these data centers, using them for enterprises with thousands of people, and then consumers as well. And then Meta's offering up its services to advertisers, but then regular folks who are on Reels and scrolling through, I don't know, whatever, food or people's vacations or my very basic pictures of beer and food and video games. It does feel strange.
Yeah. Yes. And so, Brent, let's go back to you on this. I think we have you back. Maybe, hopefully. Hi. There he is. There he is. So we were just talking about a point that one of your peers on the street brought up, which is sort of Meta's Capex relative to its revenue, and that it's higher than pretty much all of these other companies. Does that concern you at all?
No, because they're in the consumer world and they're monetizing this. If you think about what happened, Meta's headcount is actually down from the peak. And so they're generating accelerating revenue and profits despite all these investments with fewer people. So what does that tell you about AI? It's working. They drove in the quarter 9% price increase in advertising, and it's because of AI. So the Capex number, I think, is just getting completely overblown, which is like, if you're spending the money, you're getting the return. Who cares what they spend? And last night we raised our Capex number for the industry. And just in the last week, we've raised Google, Meta, and Microsoft by $50+ billion. And what I'd say is you're seeing this in the numbers. Microsoft accelerating Azure, improving operating margin. Amy Hood, the CFO of Microsoft, gave you operating margin improvement for the last 2 years in the face of AI. Meta just gave you accelerating revenue growth and improving margin with fewer headcounts, and it's because of AI. So the point is, like, who cares what you're spending as long as your bookings and the revenue growth and the margins are going higher, and that's what's happening. So I think there's just, again, I understand that the number one question I get from our investors, which are institutional investors, feels like the railroad companies. Like, we're putting these railroad tracks in, we don't know when the ROI is coming. That's not true. You see the ROI today. The numbers are very clear. And if people listen, you're hearing it. Amy Hood has said this. AI margins are higher than cloud. What does that tell you? So I don't know. I don't know how to be, more crystal clear. Revenue, margins, building, accelerating in the face of all these investments. And by the way, we're literally at the beginning of this wave. We're not at the end of it. And so, again, I think in many of the past cycles we've been in, it takes longer for this to happen. Cloud took a long time. Internet took time. We've lived through these cycles. This cycle's happening faster. And oh, by the way, every CEO from JP Morgan to the CEO of Medtronic to the CEO of United Airlines you go through it. Every CEO, including our own CEO, we're all being asked at Jefferies to embrace AI. And if we don't, there's big consequences. So I don't think this is a question of, is this paying off or not? I think it's pretty clear it's paying off, and you're seeing it already in the numbers.
Yeah, and when I was talking about the tipping point earlier, that's kind of what this quarter feels like in particular, that the proof is really showing up for these companies. All right, I'm going to leave it there. Dan,
it's super early. I mean,
yes, it is definitely super early. But we'll see how it goes. Brent, Dan, got to leave it there. Thank you so much. Appreciate it. We got much more market action coming up, including a deep dive into the Federal Reserve and when tariff impacts might start to show up more in inflation numbers. You're watching Market Catalyst. The Federal Reserve leaving interest rates unchanged as Chair Powell sticks to a wait-and-see approach on the prospects of a rate cut in September. Powell's main message in his press briefing was that there was insufficient information about the inflationary impact of President Trump's tariffs. Joining me now, Seth Carpenter, Morgan Stanley Chief Global Economist. And of course, Seth, first of all, it's great to see you. You, of course, along with everybody else, has been following the effects of tariffs here in the U.S. and globally. We know that there is a lag because of when and how the tariffs have been instituted. This is something that Chair Powell has been talking about. What's your view on the question of when we will start to see it more and whether that effect is going to be sustained?
Yeah, no, it's a key question here. And so we tried to do a bunch of work looking at what happened in 2018, for example, looking at everything we can scrounge from, looking at changes in prices for supply chains. Looks like in a macro sense, it's about 3-4 months after tariffs get implemented that you start to see it in the inflation data. And then it's probably 2, maybe 3 quarters until you start to see the effects of tariffs pushing down economic growth. If you remember back in 2018, when President Trump was president before, tariffs on China were imposed. The second half of 2018, we saw some disruption to manufacturing because 2/3 of what we import from China are either capital goods or intermediate goods that go into manufacturing in the US. So the tariffs are just taxes on US manufacturing. We saw manufacturing industrial production start to fall in the second half of 2018 and keep falling for 2019. So where are we this time around? Well, we know that we just got some inflation data for the month of June, and it looks like most of the tariff-sensitive categories started to show that pickup. So that's kind of that 3 or 4 month lag that we had in mind. So we expect the inflation data to keep showing increases in tariff-sensitive categories for the next several months, really pushing up inflation for the third quarter quite notably. And then, in the fourth quarter, we're probably going to see a big drag on the economy coming in from tariffs, augmented by the drag that the immigration restriction is doing. So we're seeing everything play out in the data now as we had anticipated.
And so, Seth, that implies that people on the street who are waiting for the Fed to cut rates, they might be disappointed for a while, not to mention the president himself.
Yeah, I think that's right. Our base case, once we had the announcement of tariffs coming in faster, bigger, sooner than we had originally thought, they all came in really aggressively in the beginning of the year, we changed our forecast. We said if that's the way it's going to work out, the Fed probably won't cut rates at all this year in 2025. The logic being, and it's very consonant with what Chair Powell said yesterday, inflation is still above target and the labor market for now is just fine. And so there's no reason for the Fed to cut in that circumstance. If inflation goes higher from here, well, that gives them all that more reason to stay where they are with policy, slightly restrictive. And even if and when we start to see some degradation in the economy, some slowdown in the labor market, if inflation is still now high and rising at that point, the bar for them to cut rates has got to get worse as long as inflation is rising. So that's how we get to the idea that they're probably not going to cut rates this year. The market was in a very different place from us a month ago, 2 months ago. Judging from where things are now, the market's putting a little bit less than even odds on a cut in September, reducing the expectation for cuts this year. So I'd say the market is coming to the same view that we have.
Seth, sort of looking at it as a case study, I know you're looking at autos and auto pricing, which has not seen sort of the effect of tariffs. So could you walk us through that just as an example to sort of illustrate how you get these lags in the effect?
Absolutely. No, the auto industry is very much the exception that proves the rule in this case. It's an industry very, very large and yet dominated by a much smaller number of firms. And what we think we're hearing anecdotally and possibly seeing in the data is that for now, some of the larger firms are waiting. They're absorbing some of the costs in their margin until they get a better sense of exactly where these tariffs are going to end up. There's also a sense that they can wait and see if, maybe they can take some market share because, other firms are facing higher costs. And if you can keep your prices down for a while and take some market share while the rest of the industry is suffering, then that's another possibility. So I do think the auto industry is about a bit of pain now in terms of absorbing the cost and the margin. That can't last forever. And so we expect those prices in autos to start to come up in the next few months as well, maybe a bit more of a delay than the rest of the economy.
And Seth, you're a global economist, so you don't just look at the U.S., you look globally. Something that we here have talked less about is not just the effect of tariffs here, but the effect of tariffs on the economies on which they're being imposed, right? And even if, we talk about, the consumers might be paying some of the tariffs, companies might be paying some of the tariffs, how is this playing out in the EU, for example, where we just got an agreement?
Yeah, no, I think one part that's really important is, by and large, there is a bit of an asymmetry here. The U.S. is imposing far more tariffs on the rest of the world than the rest of the world is imposing on the U.S. And so what that means for the U.S. is we get a boost to U.S. inflation, and we're also going to get a hit to U.S. economic growth. For the rest of the world, you don't have that inflationary impulse because their exports to the U.S. are being tariffed, so there's less demand in the future for their exports to the U.S., and that's going to be disinflationary for the euro area. But it will be negative for growth in the euro area as well. And we heard some of the political leaders in Europe grumbling a bit about where the deal ended up, because there will be some cost to Europe when it comes to growth.
And what about globally? Where is the sort of place around the globe that is most at risk from the tariffs that we are imposing?
So I think Europe that we just talked about is at risk, but Asia's got lots of challenges as well. The tariffs that are being imposed on China seem like they are larger, more focused. There's clearly a different relationship between the U.S. and China than with any of our trading partners. There's clearly a difference in the way that the president sees the U.S. trading relationship with China. And so we think that China is one very key part of the global trading order for two reasons. One, they'll get higher tariffs than the rest of the world. And second, they really are and have become over decades the manufacturing hub, a big part of the global supply chain. And so I think from China and then emanating further out for the rest of Asia, you're going to see some reasonably strong negative effects.
Seth, great to see you. Thanks so much for joining us.
Thank you, Julie.
Coming up ahead of President Trump's August 1st deadline, we're speaking with a former U.S. trade representative about how the trade war is reshaping U.S. policy. We'll be right back. President Trump unveiling a flurry of new trade deals and announcements ahead of the August 1st deadline. That includes new national rates for South Korea, Brazil, and India, as well as suspending 50% levies on copper, but still having those tariffs on finished products, or there are different rates for different types of copper. Has the president's trade war reshaped U.S. foreign policy overall? Michael Froman is currently the Council on Foreign Relations president. He's also a former U.S. trade representative under the Obama administration, and he's joining me now. Mike, thanks for being here. Appreciate it. So the latest sort of back and forth that we have gotten has made it clear that most of these are frameworks for agreements, but the details are still being worked out. Given your experience here, we know it takes a long time. How do you expect it to unfold from here?
Well, as you said, we have the broad outlines of an agreement. There's been some disagreement even among the parties as to what the numbers are in some cases, but now there's the details. For example, when you announce a tariff on a product, you then have to negotiate what constitutes a product for the purpose of that tariff, like how much local content can go into it, how much content from other countries can go into it. And those can be painstaking negotiations. And my sense is that the U.S. Trade Representative, the Department of Commerce, will be engaged in those negotiations with the major countries to try and get those details worked out in the coming months.
It seems as though our trading partners have started to become accustomed to the way the U.S. is now doing things in terms of negotiations, for example, being much more public than they were in the past. President Trump himself liking to sort of put his seal of approval here on this. How difficult do you think that shift has been for them, given the sort of decades prior of how these things were conducted?
I think there was some degree of denial at the beginning of the administration, but as you said, they've shifted pretty quickly. If you had said a year ago that major trading partners like the EU or Japan would face 15% tariffs, I think people would have been up in arms in Europe and Japan. Right now, they're just grateful that they're not 50% tariffs. And so I think the president actually has been quite effective in setting some very high aspirations or threats, and then agreeing to something that is significantly less, but still a very significant increase in tariffs. And the other countries have basically capitulated. And they've capitulated without retaliating, largely. China's retaliated a bit, but most of the countries have not imposed tariffs back on us. And we'll see whether that changes over time.
And so I guess what I'm curious about is whether this is a more fundamental, sustainable, long-standing change to U.S. foreign policy and trade policy that you think is going to last perhaps even beyond President Trump? Or are we going to get at some point a return to sort of more traditional ways of doing it?
I think it will depend in part on what the economic implications of these actions turns out to be. As your previous speaker said, how much more inflation is there? What's the impact on reducing productivity? Does it slow U.S. and global growth? What companies and sectors go out of business here because they can no longer afford to produce their product competitively? And how do you balance that against what the president hopes to achieve, which is to drive more manufacturing and more investment in the United States? If we see the negative economic implications play out as most economists expect over the next couple of years, then I think the pendulum could shift partly back in the other direction, not all the way back. If, however, it turns out that the president's able to achieve his objectives without increasing the cost of living, without putting us into a recession, then this may be the new way of doing business going forward.
You know, when you look at figures from the Yale Budget Lab, which a lot of folks have used as their sort of benchmark, their estimate is that the effective tax rate, given what we know now, is going to be right around, or tariff rate, I should say, is right around 18%, which would be effectively the largest tax increase that we've seen, since the 1930s. So, you know, how do you think this will play out? Will our negotiating partners also be able to use that at some point as leverage in some of these discussions?
Well, I think that's right. I mean, at the beginning of the Trump administration, the average applied rate was something closer to 2.5%. So we're going from 2.5% to 18%. And obviously it varies a bit country by country and product by product. But fundamentally, the economy is going to become, by definition, less efficient, more expensive, more fragmented. And that's going to have implications for American households, how much they have to pay for basic goods, and for American manufacturers who rely on imports as critical inputs into our manufacturing process. So seeing how that plays out, I think, will be very important. And as you said, if it has a significant economic downside implications, then I think our trading partners have a degree of leverage to renegotiate these packages in the future.
Michael, as somebody who's done this before, were negotiators and negotiations friendly in the past? Were they too friendly and cordial? Do you think that there is something to be gained from this more sort of adversarial stance?
Well, I don't think anybody who's been involved in trade negotiations in the past would say they were overly friendly. They're quite contentious. They go on for a long time. There's a lot of conflict because every country has domestic politics around its economy. And so they're bringing those domestic politics to the table, and you're trying to find an agreement that fits that Venn diagram of what everyone can ultimately sell back at home. I think what the Trump administration has done is to say, okay, we'll try to negotiate, but if we can't negotiate an agreement that's to our liking, we're simply going to announce the result, and countries can take it or leave it. And if they leave it, then they get a higher tariff and they lack access to the U.S. economy. In the short run, that's a very significant use of leverage. The question will be over the long run, do other countries retaliate either in an explicit way or through a number of non-tariff barriers that they can put up to our exports? And how does it affect the broader relationship on alliances, on defense cooperation, where we need them politically to stand with us, for example, vis-a-vis China, on technology cooperation? And that'll be the question. To what degree does the trade policy spill over into other domains?
And Michael, what about the value of bringing back supply chains to the U.S., particularly those that are, sort of nationally sensitive for national security, whether you're talking about semiconductors or pharmaceuticals, for example? Do you think that this will be an effective way of reshoring some of those industries?
So first, I think there is a case for making sure we have U.S. production of certain products and allied production of other products. We don't want to be completely dependent on China for things particularly related to our military technology. It's sort of obvious, and this will be a positive step in that direction. The Biden administration started this with the CHIPS Act, with the IRA of getting critical battery technology in the U.S. I think one question will be, in the Biden administration, it was a combination of subsidies, industrial policy, as well as tariffs. The question would be, will tariffs alone, which is what the Trump administration is pursuing, whether that's enough incentive for companies to make very significant capital investments in the U.S. to move their production and move their supply chains here. I'd also just say there may be a small number of sectors where we really need to make it in the United States. This ought to be an area where we cooperate with our allies and partners so that we can bring in products from those countries where it may be more efficient to produce it at a lower cost. Can't produce everything here in the United States at a...
It looks like, Michael, we'll leave it there. Thank you so much. Michael Froman, a former U.S. trade rep. Well, we got all your markets action coming up. Stay tuned. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Brick DePalma, live at the NASDAQ. Let's get a quick check of the latest market action about 1 hour into the trading day. The big story here is that tech is making big market moves. And what we're really seeing here in the NASDAQ is Microsoft and Meta really giving momentum to this slight uptick in stocks that we're seeing in all major indexes moving in the green this morning. The NASDAQ up nearly 1%, really led this by this momentum that we're seeing from those companies that reported out yesterday. Microsoft, you can see that company up nearly 5%, pulling back a bit from the market open. And the big story there is that they finally shared that they made $75 billion in that cloud segment Azure revenue for the year. This is the first time that Microsoft disclosed exactly how much that would be. Also, their AI chatbot, that Copilot, now has 100 million active users. AI features overall for Microsoft is now made up of 800 million active users. And so you can see there, Microsoft has certainly benefited from this AI momentum that we've seen over the past year to date, really rallying off those April lows. As you can see right there, in the last month alone, we've certainly seen momentum from Microsoft as well. Let's take a look at Meta. Meta up nearly 12%, up more than 11%, that is. And if you take a look at that company there, what we're seeing in intraday trading here is really this momentum behind the companies beating Q3 earnings and as well as announcing an increased spend in 2026. That stock moving higher today as well. What we know is that Meta is not taking this AI revolution lightly. They're investing when it comes to who exactly they're hiring, and they're willing to spend a lot of money to do it. We also know that they are building out this infrastructure, these data centers, to really support this AI revolution. And that all has Wall Street excited. A lot of the people, a lot of analysts on the street and my sources are saying that this is different than the past. This is different than their investment in the metaverse. The AI is actually seeing returns here. Their AI investments are seeing returns when it comes to advertising and spending. And that certainly has Wall Street excited. Once again, shares up nearly more than 11%, up nearly 12% in the early hours of trading here. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session. Now time for some of today's trending tickers. We are watching NVIDIA, eBay, and Moderna. First up, NVIDIA. The chip giant summoned by Chinese authorities over security risks in its H20 chips, in their view. The Cyberspace Administration of China said in a statement that the chips had a serious security vulnerability. They asked NVIDIA staff to explain the risks at issue, the location tracking and remote shutdown capabilities of the products. According to the statement, NVIDIA said earlier this month that it would resume sales of some AI chips in China after securing assurances in Washington that such shipments would get approved. Those shares, though, not showing any pain from this. Investors don't seem concerned. The shares are up some 0.6%. Next up, we have eBay. The shares there soaring after issuing a strong sales forecast. eBay has seen the sale of used and refurbished goods grow faster than other categories, with shoppers eager to save money. The results suggesting optimism for continued consumer resilience at a time of economic uncertainty and the president's trade war. The CEO of eBay saying they aren't immune to tariffs, but the platform is more resilient. And finally, Moderna is cutting 10% of its global workforce. The job cut's part of an effort by the struggling biotech company to reduce spending as sales of its COVID vaccine decline. In a note to employees, CEO Stéphane Bancel saying the company was aligning its cost structure to the realities of its business. Moderna expects to have fewer than 5,000 employees by the end of the year, he said. With sales falling short of investors' expectations, Moderna last year pushed back its target to break even by 2 years to 2028 from 2026. Those shares down more than 3%. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, we will hear from the CEO of Generac following its numbers. All your markets action coming up. You're watching Markets Catalysts.
Generac, the power equipment manufacturer, reporting second quarter earnings that exceeded analyst expectations, driven by growth in both residential energy technology solutions and commercial and industrial product sales. Net income rose to $74 million. That was compared with the $59 million in the same quarter last year. Chairman and CEO and President Aaron Jagdfeld joins us now. Aaron, it is good to see you. So you reported investors liked what they heard, Aaron. Your stock soared. Walk us through the report. What are you seeing in the business?
Yeah, thanks, Josh. Thanks for having me on. It is interesting. We had a good quarter, right? We had a great Q2. Our residential business remains healthy. Power outages. The activity was a little bit softer in the first half of this year, but obviously we're coming off of a very active outage period last year, right? With three landed hurricanes and quite a bit of storm activity that drove interest in our residential products, and that's on that side of the business. And then in our commercial and industrial business, we continue to see, again, the need for backup power, the need for resiliency for businesses, for institutions, hospitals, and now data centers. We're a new market entrant here with a new product line that we introduced. We started quoting those products and opened our order book in April. And as we said on the call, we've had a lot of early receptivity to our entrance into the market, and we've gotten some really nice orders already, and our pipeline is growing very quickly. So I think clearly the market liked our quarterly results, but they probably liked kind of our future prospects even greater, especially when it comes to some of the data center exposure.
With the consumer, Aaron, in that residential area, I'm just curious, who is the typical customer there, Aaron? Is there a typical demo, and do most pay in cash, Aaron, or do they finance that purchase?
Yeah, so the purchases, are typically not financed as heavily as you might think. Our typical buyer here is somebody who owns their own home, has probably been living in that home probably for 30 years and has paid it off and is starting to think about, what happens in retirement, how do they make their home livable, and how do they protect themselves from power outages as they age, right? So you're talking about a typical demographic. The market skews older, so about 75% of the buyers for those systems are over age 50, and so it runs the gamut actually in terms of home values, though, which we find very interesting. I mean, the product does tend to skew a bit more rural, and so home values in rural areas tend to be a little bit are obviously maybe not as robust as what you'd see in a metro area. So the product, it skews urban and exurban. We see, again, not necessarily highly financed. These are people who they're in retirement, so they have liquid savings. They have the ability to invest in their homes, sometimes reverse mortgages, other ways to take out home equity loans to pay for the product. And that's been a pretty resilient group in terms of just economic pressure, interest rates, things like that.
Aaron, I also want you touch on that data center business. How big and how fast is that growing, Aaron? I'm curious, what do you see for demand ahead?
Yeah, so this again, we talked a lot about this on the call in terms of just the interest in these products. We're new to the market, but what data center developers are telling us in the 3 to 6 months that we've been talking to them with our new products is there are two major components that they are most concerned about when it comes to the timelines around new projects, and that is access to transformers and access to backup generators. These are the things that they're most worried about in terms of creating delays in bringing new data centers online. So structurally, we think there's a gap in supply in the marketplace by several thousand units. So for us, that's an awesome place to be in terms of a new entrant to a market like this, where because we're new to the market, we've got shorter lead times. We're able to kind of fill up our order book here. And when you think about the long-term prospects, I mean, then you're back to, okay, how long does the data center Capex cycle run here? And what we're seeing, as I think every other company out there that's got any kind of exposure to data centers, is there's a lot of bullishness around this being, not only a multi-year cycle, but a true secular trend here in terms of, something that could go 10, 20 years on the back of the AI trends here that data centers are enabling.
Final question, Aaron. I want your thoughts on tariffs, just how you're thinking through that dynamic, Aaron, and how, and if at all, you've been sort of reimagining your supply chain.
Yeah, I mean, like every company, we've been watching this very dynamic environment around tariffs play out. We're responding by, obviously we want to try and limit the amount of price that we have to respond with in the marketplace to offset tariffs, but there is some pricing that's going in, but we're working very hard to, take our supply chain. And we were already on this journey, to be frank. I mean, if you go back to 2016, 2017, in the first Trump administration, that made companies like us have to rethink supply chain and where our sources come from. And then, of course, COVID hit, and that changed the world in terms of supply chains again. And so we've been on a journey here. Our exposure to some of the higher tariffed countries continues to come down. We've looked at reshoring where it makes sense. We've brought things back to the U.S. where we can. And we're obviously making the necessary adjustments to make sure that we not only have a continuous source of the components we need, but that we can remain competitive with those products in the marketplace.
Aaron, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thanks, Josh.
Coming up this hour on Market Catalyst. First up, President Trump's trade deadline looms. So who has a deal and who needs to make one by midnight? We'll discuss. Plus, we sit down with the CFO of Rolls-Royce as the aerospace firm boosts its outlook. That conversation's coming up. And Figma is set to begin trading on the New York Stock Exchange after raising $1.2 billion in its IPO. All that and more coming up on Market Catalyst. First, let's get a check on the markets. 90 minutes in the start of U.S. trading. I'm Julie Hyman. As we look at stocks today, we are starting to now see a little bit of a come down from the early highs of the session. Earlier, we were seeing the NASDAQ climb as much as 1.3%. Now it has cut that almost in half, still up about 0.75%. The S&P 500 up 0.4%, and the Dow is little changed. What's the big difference here? Well, among other things, Microsoft, which was up strong out of the gate after its earnings last night and again this morning, has given up some of those gains. So that's one of the things we continue to watch. Also on the list, several new trade agreements announced ahead of President Trump's August 1st reciprocal tariff deadline, including a new one with South Korea. Here with more, Yahoo Finance Washington correspondent Ben Werschel. Hi, Ben.
Hey, Julie. Yeah, so we're 13 hours away from this latest Trump deadline at midnight tonight. Who's counting? As you mentioned, South Korea is the biggest trade deal we've had recently. This is America's sixth largest trading partner, and what they've secured is a 15% tariff rate, which is in line with the rates we've seen otherwise. It features promises of a $350 billion investment from South Korean companies that will be the details will be fleshed out later, as well as energy purchases. The overall takeaway here, I think, is that this is in line with the Japanese deal that was announced 3 recently, this 15% rate, especially the fact that the rate applies to autos, that sort of puts South Korean companies like Kia and Hyundai on par with Japanese auto companies like Toyota. So those two countries are now on similar footing. We also have some clarity this morning on the sector side tariffs here, which is in a lot of respects have bigger implications, which is that this Japanese officials have confirmed that the 15% rate applies to pharmaceuticals and semiconductors as well, in their deal at least. We don't have the exact same clarity on the South Korean deal, but it underlines the fact that this 15% rate is the new standard, at least what the White House is trying to make it. So it was 10% before, now it's 15%. What we're expecting tomorrow is a 15% global rate with some exceptions, as the White House calculates that traders may not love a 15% rate, but certainty at a 15% rate is better than the ups and downs we've seen in recent months.
And Ben, several countries like Canada, India, Brazil, they could wind up still facing steep U.S. tariffs. So how did they wind up out in the cold, not included in some of these other negotiations?
Yeah. These are the three countries who have seen their talks go most sideways in recent months. A lot of these countries were expecting a deal or weren't expecting to be an issue, but right now they're expecting to see higher rates than this 15% rate starting tomorrow morning. What's striking to me, and I wrote about it this morning, is that these are three countries on three different continents who have seen things go bad for them for three kind of very different reasons. The most political one I would put is Brazil. They're facing 50% rates starting tomorrow. And the issue here from Trump, as he openly says, is there is a Trump ally, Jair Bolsonaro, who's undergoing trial there for trying to a recent election result where he lost and tried to cling to power allegedly. There's sort of unclear how Brazil gets out of this, because Trump has promised this 50% rate. He's declared an economic emergency largely in response to this trial of his ally, and Brazil actually has a trade surplus, or the U.S. has a trade surplus with Brazil. So it's unclear sort of how trade negotiations are going to proceed there. On the other side is India. This is a truly, from all indications, a real trade fight. India, outside of China perhaps, is the country that's most stood up to Trump and sort of stood their ground. We've been talking about an India deal for weeks now, and it just hasn't been in the offing. The word Treasury Secretary Bessent used today was frustrated with India. So they're going back and forth there. Some analysts say that this is a kind of last minute fight for concessions as opposed to any sort of larger breakdown, but that is clearly not on the offing, at least today, with Indian officials talking about the fall as a timeline for there. Halfway in between here is Canada, our northern neighbor. This is the largest importer of American goods. It's kind of a combination of politics and trades fights that are there, but the big deadline there is next year when USMCA is up for renewal. So we have that to talk about for a whole nother year.
Oh, lucky us. Ben, thanks a lot. Appreciate it.
Sure thing.
Rolls-Royce Holding, a UK-based aerospace and defense manufacturer, reported strong results for the first half, raising its full-year profit outlook and sending its shares to a record. The stock's been on a tear, up over 100% in the past year. And joining me now for a deeper dive into the state of the business is Helen McCabe, Rolls-Royce CFO. Thanks for being here, Helen.
Thank you for having me.
So first of all, let's talk about what drove your numbers in the first half of the year. I know a large part of it was the civilian business. So in other words, engines for civilian planes. But talk me through a little bit more about that demand and what drove it.
Fantastic. And as you say, strong results for the first half. Operating profit standing at £1.7 billion. That's 50% higher than a year ago. Cash flow at 1.6 billion, that's 400 million higher than a year ago, and returns more than 19%. So a really strong performance. And that performance was strong across all of our three big main divisions, so civil aerospace, defence and energy. In civil aerospace, that came from our large engines, where we saw strong profitability in relation to margins, higher shop visits, so that's the amount of overhauls that we do, and the work that we're doing on commercial renegotiations. In relation to power systems, if I just maybe call out a few, so that's our energy business, a really strong performance coming through from our power gen business, where data centres is based. So if you look at that business, revenue's up 45%, orders up 80%, and a strong performance in the governmental part there as well. But also across the entire organisation, a lot of work happening on cost efficiency. So since we put our transformation in place at the end of 2022, we've delivered more than 450 million of cost efficiency benefits. And that gives us a total cash cost to gross margin ratio of 0.35, which is industry leading. So really strong performance across all three divisions coming through there.
I want to dig a little bit more into the plane engine business. As you said, you have embarked on, the management team there has embarked on this big turnaround plan, which we can see the proof is in the pudding in the shares and what investors have been doing. I do want to ask about competition with General Electric in particular. Some customers have been opting for their engines over yours. You have had some maintenance issues. It sounds like you're addressing that now. You're have some spending plans this year to improve on those maintenance issues. What can you tell us about that and what your hopes are for regaining market share there?
Fantastic. So as you say, lots of work happening in that space. Maybe a couple of data points to help. Since 2022, our percentage of installed engines, so the new engines being delivered in the market, has actually grown 10% per annum for large engines. That compares to the rest of the market, which is an average of 5%. So I think that gives you a little bit of a flavour around how we're performing in that regard. You referenced what we would call durability. So some of the challenges that we've had with some of our platforms, notably Trent 1000. We are spending £1 billion on a multi-year programme called Time on Wing, and that's about how we ensure that the engines can stay flying in the air for longer before they have to come in for shop visits. And just in this period, we achieved 2 significant milestones on that. We have an ambition to improve our time on wing across our modern engines by 80% by 2027. Because of our actions and the milestones that we have achieved, we have now either delivered or de-risked more than half of that 80%. That's material. In relation to the Trent 1000, we have just approved certain certifications. That certification alone will double the time on wing of that engine, and there's more to come at the end of the year. So a very competitive engine, huge programme underway, which will give us exceptional durability and time on wing going forward.
Helen, I'd also like to ask you, of course, about tariffs, right? We have a little bit more clarity now because of the agreements with the UK, where you're based, as well as the EU. But what does your manufacturing footprint look like, and what is the tariff effect for Rolls-Royce?
Okay, so maybe just worth saying up front that we always comply with all applicable laws and regulations in every country that we work with and that we have representation in. In relation to tariff impact for us, it's been an area that's moving very, very quickly. We were very quick to assess the impact to us and to our customers. The recent UK-US trade deals, and indeed the one that was announced with Europe just earlier this week or last week, actually exempts aerospace engines and aero parts from tariffs. So that is quite important. In relation to our other business, our energy business, there is still some impact there. But we have been very, very quick as to how we have responded to that, and we have fully mitigated the impact. We stood up teams to understand the impact to us, to our supply chains and our customers. So we've been quite clear that that impact is mitigated. We continue to assess and keep a very close eye on the indirect impact. So what that may mean for growth rates, inflation, foreign exchange volatility going forward. But we've been very, very receptive and very, very quick about how we've responded to that. It's maybe just worth saying that we have a material presence in the US. We've got 5,000 people that work for us in the US across 26 states. We have a large production facility. In fact, the DoD is our largest customer globally. And just last month, within the last few weeks, we announced an investment of more than $100 million to build out further production capacity in the US. So very responsive as to how we've leaned in and understood and responded to tariffs. But we also have a very large presence and footprint, which we're very proud of in the US as well.
Helen, thanks so much for your time. We appreciate it.
Thank you.
Coming up, much more markets action ahead, including the tech impact on the equity markets. You're watching Market Catalysts. Markets continuing to drive higher, powered by big tech, despite the threat of tariffs and the Fed's decision to hold interest rates steady. Joining me now, Omar Aguilar, Schwab Asset Management CEO and CIO, and Yahoo Finance Senior Markets Reporter Josh Schaefer. Omar, I want to start with you because I mentioned that stocks are pushing higher, but and I don't know how much you watch the day's moves versus longer term moves, but we're seeing stocks kind of come down off the highs. There was this big enthusiasm about Meta and Microsoft, and now that's sort of fading a little bit. Is there anything to read into that?
Well, we do look at both. We look at the long term and we look at short term too. We have seen an amazing recovery since April. I mean, the market has recovered so strong with a lot of force, with a lot of breadth, which is critical. And now we seem to be in this place where we are priced to perfection. A lot of the earnings that we have seen over the course of this reporting period, have actually been positive and solid with some signs of stress going down the path. And I think that's a little bit of what the market seems to be reading into. It's not necessarily the actual reports, but what's yet to come. And the big story so far seems to be related to margins.
It does seem to be related to margins, but it seems to be related to technology in particular. And Josh, I want to get you to dig into this a little bit because we have seen the earnings growth, the bulk. I mean, we've been waiting for several quarters now for it to, not just the stock performance to broaden out, but the earnings performance to broaden it out. And that hasn't exactly happened yet.
Yeah, we run a chart from FactSet, it feels like for the last 3 quarters now, showing Magnificent 7 and the 493, and the gap is going to close, and that's because those are earnings estimates. And then when the actual earnings come out, Mag 7 usually outperforms more than people expected, and the 493 have been sort of mixed, right? So you're seeing your earnings growth definitely in other areas, but when you look at where earnings have been driving the price action the most. We were talking about this with one of our charts from the Yahoo Finance chart book, right? Venu Krishna had pointed out over at Barclays that essentially big tech is the only area of the market, that's your chart there. Yellow is earnings growth. Yellow is under big tech is the only area where earnings growth has actually outperformed price action year to date. So it's the only area of the market amid this rally where earnings growth continues to sort of lead. A lot of other areas on there on that chart where you have a lot of multiple expansion where you haven't actually seen the earnings growth yet.
Right, that's on the left side of the chart, the tech stuff. So Omar, I guess I would put to you, is technology the area where you feel like investors have to be given that growth?
Well, for the last several years, especially that big tech have been similar to just a name of stability. They have provided the stability of the market. They have provided the growth the market wanted. And I think this is the first time, and we were discussing this earlier, that we have seen the benefits of the capital expenditures that have gone into AI translated into productivity that has provided that additional EPS growth future. So it is amazing, not for all the Mag 7, but for some of the Mag 7 that have actually done well when they can actually see those investments in AI early on is starting to produce return on investment.
But I guess the question is, how long will investors be willing to pay up for that growth that we are seeing from those companies? We haven't seen any real hits to that as of late.
Well, if you think about the definition of, especially in technology, between hardware, software, and then services, areas where you have high profit margins, where they tend to be more service or software related, they tend to have more potential runway to continue to grow at that pace because they're not as affected by macroeconomic conditions, and they tend to seem to be doing very well. And the amount of free cash flow that they generate, while they may not necessarily be at the same pace, I think they're still represent a very good opportunity.
We were just showing a chart that, Josh, I know you and I have been talking a lot about, which shows the contribution from this Capex spend to the economy.
Yeah, this is an interesting chart. So this is a chart from Neil Dutta over at RemMac, and what he's looking at is different contributions to GDP. This is off of yesterday's GDP print. Your white line there would be information processing equipment spending and what that's contributing to GDP. The green line would be consumer spending, which has been moving lower. So what you're actually seeing, at least in the most recent quarter, would be spending on AI and spending on technology actually boosting GDP a little bit more than the consumer. And Omar, this sort of raises two questions for me, which is, the white line seems good, right? The spending on AI certainly seems to be helping, but also is there a concern about the consumer? How do you sort of take those two lines and put them together and make a little bit of a sense of it for us?
It is, you see the charts together, they're basically offsetting each other, right? In certain way, if you look at the GDP numbers that we have seen, even though they have been more driven by imports and exports activity, that contribution to GDP for Capex is, I think, just at the beginning. The big part of the potential of extension of the fiscal stimulus, that actually provides quite a bit of a potential boost to Capex and consumption. So again, the biggest question on consumption is still goes back to tariffs. Whether or not we're going to see a significantly more reduction in consumption as a result of tariffs, because prices will go up and inflation will go up. That we haven't seen, and I think that's the bigger question that we have to just, and that will have an effect on GDP.
So do you think, given what we heard from the Fed yesterday, that rates will indeed continue to be higher for longer? And then how does that inform your investing strategy?
Yeah, well, it's a great question, because everybody talks about the Fed and what it's going to be and the timing, and I think if you hear specifically about their actions, they were very careful in not necessarily providing any guidance about any timing about it. When you look at the mandates of what the Fed has, they look at labor, the job market, and they also look at inflation. And then the third mandate, which is not quite directly linked into that, is price stability. And when you actually look at, okay, GDP looks good, earnings looks good, the labor market softening a little bit here and there, but not bad. And you look at the housing market, again, softening a little bit, not bad. So a lot of these components seem to be in place. And with the latest inflation numbers ticking up a little bit, that justifies a lot of their decision to hold rates. So if you think about everything they have to be in place, the economy is holding up well, the market seems to be in good place, the stability of prices continues to drive investor behavior. That seems to be, sustaining the fact that they can wait for longer. They're not in a rush to make decisions.
And so how does that then inform the investing strategy? Are stocks going to just keep going up?
No, good question. The big part of our investment strategy, what we say is we should be prepared for more volatility down the road. There is a very clear message that the economy will slow down. All these effects that we're talking about, and in this part of the cycle, we should expect that slowdown. We don't necessarily anticipate a hard landing or anything of sorts, but we should expect more volatility, and we should expect more inflation being at that places without tariffs being in place. It creates more uncertainty, and we'll see more volatility down the road. So clients need to be prepared for that. So to answer your question, quality, stay in quality, look for profitable companies with high margins, companies with free cash flow. Continue to go that path. Fixed income, bonds are as attractive as they will ever be, because if rates are actually going to change, they're going to go down. So this is a good time to lock in yields, especially in the area of high quality, AAA corporate, bonds that are pretty attractive at the moment. You don't have to take a lot of junk bonds or a lot of high yield risk to take the spreads that are available today. And, take advantage of the current cash yields. The cash, is very good right now until the Fed makes a decision, and we still may have, some time. So, stay in quality, stay defensive is probably our strategy at the moment. You don't necessarily need to take big moves or become a hero, and rebalance. Find opportunities to rebalance your strategy to make sure you reduce exposure to where you have more. International markets is another good opportunity. We also see the dollar being weaker, for a little longer. International may benefit from it.
Okay, Omar, great to see you. Thanks for coming in. Appreciate it. And thank you, Josh. Well, President Trump announcing on Truth Social he is extending Mexico's current tariff rates for 90 days to allow more time for trade negotiations with the country. That announcement coming after Trump threatened last month to increase Mexico's country-based duty to 30% starting August 1st. The president's decision coming shortly after he said he would not extend his Friday deadline. Joining us now, Washington correspondent Ben Worshkel. Ben, we were just talking about the countries that have been left out in the cold, so to speak. Mexico was one of them, but it seems like they're getting a little more time, but the time that they're getting comes still with these high tariffs attached.
For sure, yeah. So this is the 90-day pause that Trump announced just a few minutes ago, and it'll keeps the rates at 25%. So it's not a 5% increase to 30%. I do think it's significant that Trump talked about this call as very successful. He had a lot of kind words for Mexican President Claudia Sheinbaum as they met this morning to kind of work out these deals, considering how many issues they have to work out over the next 90 days on the border and these other things. Other things Trump announced today in this post will be that the 25% headline rate will continue, the 25% auto rate will continue. That's a big one in focus. And then, as with all the other deals, the 50% tariffs on steel, aluminum, and copper, which is also coming tomorrow, will stay in place. So those rates will stay now. Trump also announced that Mexico has agreed to terminate its non-tariff trade barriers without providing any additional details there. The President Sheinbaum did already respond to confirm this call and to confirm the 90-day pause. What she says she's focused on for the next 90 days is building a long-term deal with President Trump on all these other more complex trade issues.
Ben, thanks a lot for the update. Appreciate it. Mm-hmm. Coming up, all your markets action ahead. Plus, we're going to dive into the cybersecurity industry. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Shake Shack, AB InBev, and Figma. First up, Shake Shack sliding today after issuing a weak forecast. The company citing a slowdown in consumer spending and inflation as the causes for the slowdown. With us to discuss our own Brooke DePalma, who covers this one closely. 16.5% hit there for Shake Shack.
Yeah, certainly. What we saw there was, once again, another fast casual chain reiterating that consumers really cautious right now. They're inflation wary, and they're really counting their pennies. They're looking for the best bang for their buck. And as we heard from Chipotle, value proposition is everything nowadays. And it seems like consumers are trying to assess where they can get that. And certainly what we saw here was that forecast when it comes to the next quarter. Really, what we saw was that there was high expectations here. Now they're expecting that revenue to not be in line with what Wall Street had expected. The CFO, though, did say on the call that traffic as each month went on did improve. But, Julie, they came out with that Dubai shake this past quarter. And so there was lots of optimism about what this could look like. They did say that even though consumers came in for just that pistachio viral shake, that it actually drove up the ticket there. But they did say that there was ways that they could certainly work on making sure that they hold on to that share, hold on to that value proposition. But despite a small single-digit increase in same-store sales growth, when you think back to a few years ago, we were posting double digits when it came to their same-store sales growth, or as they call it, same Shack sales growth.
Have you tried the Dubai shake?
I didn't, but I mean, maybe now I will.
It sounds really good. I'm reading about it right now. Okay, next up, speaking of consumables, AB InBev, the parent company of Bud Light, dropping by the most in 5 years today. The company sold less beer than expected during the second quarter, with the downturn in consumer spending in Brazil and China in particular dragging on sales. And I believe you had a chance to talk to the company, Brooke.
Yeah, I spoke to the CEO this morning, and what he said is that when it comes to China, the consumer that they're seeing there, they're over-indexed in restaurants and bars, as well as the eastern region of the country, rather. And what they know is that this consumer there is staying at home, and so they really have to reevaluate, especially as perhaps beer isn't top of mind for that consumer as well. And over in Brazil, the story there that really led to those volume declines is poor weather, as well as a value-seeking consumer. And to bring it back home here in the U.S., he said that they're also seeing a value-seeking consumer here in the U.S. He said, quote unquote, some pockets of consumers are more under pressure due to inflation in the last few years. And those, once again, are value-seeking consumers. And here in the U.S., we did see sales to retailers decline yet again. But he said that there's this momentum behind these value-oriented brands like Busch Light, as well as low-carb, low-calorie brands like Michelob Ultra. And those are two brands he certainly has an eye on, and he expects to outperform in this sort of environment.
And thanks, Brooke. And finally, Figma raising $1.2 billion in its IPO. The company set to begin trading on the New York Stock Exchange any moment now, as we start to see the IPO market just crack open a little bit once again.
Absolutely. And what we've learned this past year is when these sort of either data-driven, AI-driven, or crypto-driven stocks debut on the exchange or debut to the public market, what we've seen is investors really pleased, really excited, and really into these sort of trades. If you take a look at how Circle's perform, it's up more than 510% since its open back in June. We also know that CoreWeave, which actually got an upgrade from Citi today because of the Microsoft cloud computing segment doing really well this past quarter. We also have seen CoreWeave do really well. It's up more than 160% since its debut. And also worth noting here that Figma's IPO comes after it had abandoned plans to sell itself to Adobe. And so this is certainly one that investors have their eyes on, and we'll see if it ends up getting the same returns as previous of this year's IPOs have gotten.
Yeah, I saw the latest indications here were for it to open at $65 to $70. The IPO price was $33. Not too shabby for Figma. All right, thank you so much, Brooke. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Microsoft has confirmed that Chinese hacking gangs are behind sweeping cyber attacks that hit multiple U.S. government agencies. Hackers took advantage of a flaw in Microsoft's SharePoint software. Investigators still looking into the scope of that attack. But joining me now on this thread and the broader state of cybersecurity is Shlomo Kramer, Cato Network's co-founder and CEO, joining me here in the studio. Thank you for being here.
Thank you for having me.
So obviously that was just the latest in a long chain of attacks that we have heard about. How would you characterize the current state of threats that we are seeing against corporations and government entities?
Ever increasing against what I would call a broken cybersecurity economy on the other side that is simply can't keep pace with the advancement of the attacks, the complexity of the digital business, the agility of it, and the cost that it takes to take all these products and turn them into a solution that protect against these attacks.
We've talked about this a little bit before, but just tell us again why you think that the industry has not sort of met the scope of those attacks.
Primarily because, not because of products. The solution is 20% product and 80% people that operate them. And there's simply not enough talent out there, simply not enough budget out there to manage all these products. And there needs to be a new way. And there's more product because there needs to be innovation, because the attacks are progressing. But that innovation needs to come in different form. And that form, I believe, is now going to be platforms. Right, so instead of having 60 products, I'm going to have 4 platforms, and this is going to create a completely different economy of consumption and delivery of security, as well as completely different economy of innovation. Innovation through platforms, not only through point products.
And we've already seen that migration and that shift start to happen in the industry. Where do you think the biggest threats are coming from right now?
So it's always unfortunate human nature that any great innovation is first used to to be weaponized. So whether it's railroads or atomic energy or AI. So I would say AI, obviously right now, is the big elephant in the room that will be used for cyber attack, will be used to information attacks, fraud, and in particular in cyber, it's going to be very, very challenging because the rate in which enterprises adopt AI, want to adopt AI, is going to challenge all the security companies to provide a safe journey to that.
I want to talk a little bit more about Cato specifically.
Yeah.
You just heard us talking about Figma and the IPO market.
Right.
I believe your latest funding round put your valuation at around $4.8 billion. How are you thinking about a potential IPO, if at all?
So we are a hyper-growth company. Last year we grew 46%, and we ended with $250 million of ARR, and We continue that trajectory, which is almost twice the rate of the market growth. It's the beginning of a journey. It's a long journey. It's a huge market. It's a big opportunity, and we are considering our options at each stage. The private markets are sophisticated now. The public markets are opening a little bit. We had a good opportunity to raise money, although we didn't need that. And we'll continue to evaluate it down the road.
Okay, so we'll see, in other words.
See.
I'm also curious, we've seen a little bit of consolidation in the industry. Just recently, Palo Alto's buying CyberArk. Do you all plan to get bigger? I mean, that growth that you mentioned has mostly been organic growth, right? The 46%.
Yeah, we are, we talked about platforms. I believe the future is platforms that are focused on a geography in the organization, a network security platform, an endpoint platform like CrowdStrike, a cloud security platform like Wiz, Cato on the network, Okta on identity. And these platforms are well integrated. The customer wants to be able to choose in each one of them. He doesn't want to buy everything from one vendor. It's not a secure choice.
So does that mean you don't see making acquisitions then to sort of try and bolt on all kinds of things?
No, so as a platform, it doesn't mean that we are not going to do acquisitions, but it means that our bar for acquisitions is much higher. We have a commitment to our customers to keep the solution converged and unified, and we are going to keep that. So we're going to do acquisition in a very selective way, only to things that can converge into the platform.
Gotcha.
Platforms, and you mentioned Palo. I would say, that's platforms are great, but that's a bridge. One bridge too far, let's say it like that. That's
a
multi-platform play. I haven't seen a company that does that successfully, a pure play security. Even Microsoft, that is obviously owning the operating system, isn't able to go into network security. So there are. It's really interesting that they diverged from network security to something completely different.
In the case of Palo.
Because network security is about to transform $100 billion re-architected in the next 10 years. So you need every bit of enterprise energy to make sure that you are doing it right. And going to identity with a player that is a human identity player, where obviously in the next 10 years, non-human identity is going to become so much more important.
Right, interesting.
So perhaps in the next year or two, this is reasonable, but when you look at that size of deal, you say, 10 years from now, what does it mean? I don't think so.
Okay, Shlomo, thanks for being
here.
Thank
you very much.
Interesting. We'll see how that other one plays out. Appreciate you coming in. It's good to see you.
Thanks.
Coming up, we're going to get earnings insights from the CEOs of Wingstop and Qualcomm. That's next on Market Catalysts.
Mutual funds have been around for over 100 years, but ETFs, they are quickly closing the gap fast. And on today's Stocks in Translation, we stock them head to head so that you can pick what's right for your portfolio. Let's start with some simple definitions here. An exchange-traded fund, or ETF, trades all day like a stock, but usually holds a small or a big basket of assets, although some modern ones only hold a single stock. In plain English, most ETFs are passive strategies that you can buy or hold any second that the market is open. Now, with a mutual fund, on the other hand, you have pooled money that might be actively or passively managed, and it's priced only after the closing bell each day. So in other words, you have only one shot per day to get in or out. Now let's take a look at how these two classes of funds stack up against each other. We just talked about liquidity, and that's when you can trade. ETFs trade all day long, and mutual funds only trade once per day after the close. When it comes to taxes, though, mutual funds can surprise you with a year-end tax bill if they've sold some of their stocks, so you need to do your research. ETFs, on the other hand, use something called in-kind swaps to keep capital gains taxes to a minimum. But ETFs can be structured in different ways, so you got to do your research there too. And now let's talk transparency. Mutual funds have to report what they own each quarter. That's only once per quarter, and they often play shell games to make sure that what they own looks good to investors as of the last day of the reporting period. ETFs, on the other hand, generally disclose their holdings on a daily basis, published the evening of the close or the following morning. And when it comes to costs, ETFs usually charge lower management fees, but that's also in part because they tend to passively track an index. For actively managed ETFs, like the ARK Innovation Fund, fees tend to be higher, and that also tends to be the case with leveraged ETFs using derivatives and those that track exotic assets like commodities, gold and oil, for example. Now, mutual funds also have to have a minimum buy-in of about $1,000, whereas you only have to lay out the money to buy one share of an ETF, which is usually much lower. And ETFs are very stock-like, so you can buy or sell options based on them or even sell them short. Mutual funds just don't have that flexibility. Now, we already talked about management fees, but when it comes to actual trading costs, mutual funds might slap on a front end or a back end fee called a load. If they don't have it, it's called a no load fund. And if you're buying an ETF, much like a stock, you just have to worry about the bid-ask spread plus any commissions that might be charged by your broker. So a quick recap here. Mutual funds win for automatic savings plans and ETFs win in most other places. Now let's check out a couple of charts that show how these two asset classes of funds have grown over the last 4 decades. Mutual funds, they got their start in the mid-1920s, but they exploded in the 1980s. And as you can see by the top white line that shows the number of mutual funds, it's been going sideways since the beginning of the century, with over 6,500 currently, and that's down over 1,000 from the pre-pandemic peak. Meanwhile, the pace of ETF growth has only increased in recent years, with the current total nearing 4,000. And when it comes to assets under management, mutual funds in white up top here have about $22 trillion, which is also the peak from a few years ago. And ETFs in green, they keep rocketing higher, now standing at about half of that, or $11 trillion. The money is moving where the flex is. So the bottom line, if you want speed, tax efficiency, and low fees, ETFs are the toolbox. And if you like set and forget it and automatic rebalance, mutual funds, they still have a place. But always know the rules before you pull the trigger. And stay tuned for part 2 of Stocks in Translation. We are pitting 2 OG ETFs, SPY and QQQ, against each other, how Spider-Woman helped build the first ETF, and how the Qs turned into the biggest fee machine ever, a piece Invesco now wants back. Don't miss it. And also tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
Earnings from chipmaker Qualcomm beating estimates, but shares are under some pressure today on slower than expected growth in phone-related chip sales. Joining me now, Cristiano Amon, Qualcomm CEO. Cristiano, it's always great to see you, and indeed the numbers beat estimates, your forecast leaving you some room to beat estimates, and those phone-related sales did rise by 7%. But I saw a lot of commentary around the mix within that segment. Can you talk us through that a little bit?
Absolutely. Good talking to you, Julie. Look, we're happy with the results. We're doing what we said we're going to do. And actually, we are seeing growth in the handsets. And important to highlight, we don't see any pull-ins. We see growth. It's just a quarter that we don't have flagship launches. We're going to have next quarter. That is reflected in our guide. And we continue to see an opportunity for us to expand within the Android ecosystem. So I frankly, I don't know what people not like about it. The most important thing, we continue to grow the company, diversify the company, and we provide a new metric, which was 15% of QCT non-Apple revenues. We're going to see the second consecutive year of 15%. So that shows the earnings power of the business, and QCT non-Apple growing double digit.
And Cristiano, for folks who are not familiar, QCT is the handset
chip
chips.
business.
And
chip business.
Right.
The
and
chip business.
Your contract with Apple for its modems, for its chips, is rolling off over the next few years. This is well known. And as you say, you've been very transparent about sort of how you're going to try to make up for that. And this new metric is sort of lending to that. You and I have been talking for a while, and diversification has been the name of the game for a while now for Qualcomm. What grade would you give yourself? Where are you in that journey for making up for that expected roll-off in the Apple revenue?
Remember, we had said back in our Investor Day in 2024 that we have a plan that we're going to create $22 billion of non-handsets. That's non-handsets, which is automotive and IoT by fiscal 29. And we've been executing diligent on that plan. And everything is tracking to what we said we're going to do. So we're happy with that execution. Additionally, we said that the Android market will be growing at 5% CAGR. We have been delivering consistently more than 5% growth on Android, which was actually growing faster than the market. So we're just executing on the plan. And what that will do will allow us to replace Apple twice. We had done it in the past. When you look at the growth that we created on the other business and continue to grow. The earnings power of the business, non-Apple, is what we provided when we provide this metric of 15% growth on the per year on the chip business.
Let's talk about Internet of Things a little bit more, right? Because part of that is going to be potentially things like the Meta glasses and other sort of personal devices that incorporate AI. What do you think is the potential for that business? You know, as you said at your Investor Day last year, you laid some of this out and we talked about it then. Now that there have been sort of more product introductions, give us an update on that.
Yes, and I'll point to what Mark Zuckerberg said yesterday, because there's also a connection with how you should think about mobile, even though this is a different category of device. We are starting to see now personal AI taking a hold. And we used to think about glasses and watches and earbuds as devices that their main job was to extend the capability of your smartphone. Now they're centered around the human and the model. And we're starting to see agentic experiences when you just connect to the AI directly. No legacy, you have just a new type of apps. They're coming with AI. And that's reflected on the fact that we've been talking quarter after quarter about the excitement we see on the glasses with the Meta Ray-Ban continue to exceed expectations. And now we have 19 different designs of those type of devices. And I think as AI evolves and the Android ecosystem is very strong now, we see an opportunity to also reflect back in increasing the size of the Android market as users are going to be looking for AI type experience for their new mobile devices.
Let's also talk data center chips, which is not something I'm used to talking about with you, right? But this is something you guys are getting into now. You said you're in talks with a hyperscaler to sell AI data center chips. Where does Qualcomm fit into the market? As I said, it's not, people are used to thinking of NVIDIA, used to thinking of AMD to some degree, or a company like Broadcom. Where does Qualcomm fit into that market?
The way investors should think about this, it creates optionality on Qualcomm. So the data center, as you know, is a massive addressable market. And because of the evolution of AI, there will continue to be investments on the data center for decades. We have assets that are very relevant for the data center. And their transitions that become incredibly important create an entry point for Qualcomm. One transition is the general purpose CPU that used to be a merchant CPU with an x86 instruction set, that is becoming an ARM compatible CPU, and you use that for a head unit of an AI cluster or for some applications, the hyperscalers for their first party software. The second thing that is happening is AI scale is moving from training to inference. You started to see inference clusters being built dedicated for inference. In that game, it's about, can you deliver the largest amount of tokens with the smallest power consumption and a better outcome and performance per dollars? This is where we believe we have IP that is relevant. We made an important acquisition called AlphaWave that complements our roadmap. We're now focused on the approval, and we start developing products and having conversations with hyperscalers. Having said that,
right,
we said that's in the beginning. We expect revenues to start to materialize in fiscal 28.
We will be looking for that. Cristiano, very quickly to leave us here, tariff impact for you guys? I know it's limited sort of by the mix of your business, but what's the impact? How are you thinking about it right now?
Direct, we have not seen any impact. And as I said before, no pull-ins related to tariffs. That's reflected in a strong guide. I think indirectly, whether that will change market sizes or make products more expensive, we're like everybody else, waiting to see how that develop. But so far, we have not seen any material impact.
Cristiano, thank you so much. Good to see you.
Good to see you too.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.